Hey everyone, I want to prepare this short video to explain how to prepare journal entries from transactions. So here's an example. Suppose the transaction we have is if the firm spent 20,000 in cash to purchase some equipment, and this is an example of the business transaction that we have. And then the goal is we want to write it into debit and credit. So we want to write a transaction into debit and credit, and this is called a journal entry. And this process of writing a transaction into debit and credit, this process, it is called journalizing. So how do we do that? The first step here is we need to first analyze the business transaction. Whenever we receive a business transaction, we need to analyze it. And what do we mean by analyzing? Basically, we analyze the effect of this transaction on asset, liability, and stockholders' equity. So the basic accounting equation is asset equals to liability plus stockholders' equity. And if you look at this transaction we have, firm spent $20,000 in cash. So what is the result of this transaction? The firm is going to have 20,000 less cash. So cash is going to decrease. And then what is the other result? So the firm purchased equipment. The result of spending this 20,000 in cash, the firm is getting equipment. So equipment is going to increase. So as a result of this business transaction, the firm's cash account is going to decrease and equipment is going to increase. And cash, it is an asset. Equipment is also an asset. So this is just a first step. Once we have a business transaction, we need to analyze the effect of this business transaction on asset, liability, stockholders' equity. And if you wonder what kinds of accounts, for example, asset accounts, what kinds of accounts are liability accounts, and what kind of accounts are stockholders' equity accounts? Here is a list of the common accounts. So for example, the common asset account, we have all of those. Those are common asset accounts. And liabilities, stockholders' equity. And then with regard to stockholders' equity, so stockholders' equity include common stock, additional paid-in capital, and retained earning. And retained earning is driven by an increase in revenue, and that it is going to be retained earnings is going to be decreased by increasing expense. It is going to be decreased by increasing dividend. So those are the common accounts. And then once we finish the first step, the second step is journalizing, which is to write the journal entry. So based on what we have so far, how do we write the journal entry? The basic rule here is, so this is something which is very important to remember. If it is an increasing asset, we're going to debit the asset. If it is a decreasing asset, we're going to credit the asset. For liabilities and stockholders' equities, those are opposite. If it is an increasing liability, we credit the liability. If it is a decreasing liability, we debit the liability. And the same as stockholders' equity. If it is increase in stockholders' equity, we credit stockholders' equity account. If it is a decrease in stockholders' equity, we debit stockholders' equity account. So specifically, continue the previous example, because we have a decrease in cash, and because cash is an asset, and a decrease in an asset account, we're going to credit that account. So a decrease in cash can be written as credit cash. Similarly, an increase in equipment, because equipment is an asset account, and because an increase in asset account is written as debit asset. So for an increase in equipment, we would debit equipment. And then one thing to say more about is because retained earning is part of stockholders' equity, and because retained earning is driven by an increase in retained earning is driven by an increase in revenue. it is driven by retained earning is going an increase in revenue is going to cause an increase in retained earning. And the increasing expense is going to, so if expense increase, it's going to cause a decrease in retained earning. And if dividend increase, it's going to cause a decrease in retained earning. So the sign of the revenue is going to be the same as stockholders' equity. In other words, an increase in revenue, we're going to credit the revenue account. Versus the expense and dividends, they are going to be the same as asset. If it is an increasing expense, we're going to debit the expense. If it is an increasing dividend, we're going to debit dividend account. As a result of all of those, the business transaction, which is firm spend 20,000 in cash to purchase equipment, it can be written into debit equipment 20,000 and credit cash 20,000. And this is how we are able to, like, based on those rules, we're able to turn a pretty complicated transaction if you count 1, 2. So if you count, like, if we want to use words to describe this transaction, we're spending 9 words. And then we can greatly simplify this transaction into just debit account, credit account, and it is also standardized. So this is what I have so far. If you have any question, feel free to either email me or come to my office hour.